Good morning, everyone. This is Rob McDougall from Zhang Financial here with your weekly economic update. Today is Monday, July 7th, 2025. So economic activity last week, we would have to say, was overall quite favorable. A couple of data points that were a little shy of consensus, but otherwise it was a pretty strong week of economic data. Started off last week, we had the ISM Manufacturing PMI Industry Survey. Slightly better than expected to come in at 48.3. It came in at 49. The JOLTS job opening number, monthly number, month of May, was expected to come in at 7.3 million open jobs in the U.S., much better than expected. Over 7.7, almost 7.8 million jobs. Now, one of the two metrics last week that was negative was the ADP employment change. ADP, the service provider, payroll, they do their own survey, so it's a much smaller subset of what the U.S. government Labor Department post. They had expected 95,000 new jobs in their survey, and it came in at a negative 33,000. So this was on Wednesday, so markets were a bit on edge as to what they'd get from the Labor Department the very next day. And of course, the next day, as the Labor Department put out the numbers, much better than expected. Non-farm payrolls were expected for the month of June to be up 110,000. It was actually a positive 147,000. So that was fantastic. Markets loved it as well. That took the unemployment rate down. Expectation in the prior month was 4.3%. Actually came in at 4.1. So one of the other two metrics last week, slightly negative, average hourly earnings came in at a positive 0.2% for the month of June. But that was expected to be a positive 0.3. So that and the ADP were the two that were slightly weaker than expected. But the initial jobless claims for the week actually came in better than expected. Expectations 240,000 came in at 233,000. And lastly, a slight upside on the ISM Services Index for the month of June. That was expected to come in at 50.5, came in at 50.8. So overall, really good news on the economic side. There is slowing, we believe, in the economy from higher rates of 2024, but certainly does not look recessionary and certainly looks much, much better than most would have thought, given the tariff arrangement and concerns back in March and April. So at the end of last week, however, the most important thing that did occur was at the end of the week. Of course, Friday was 4th of July, and on 4th of July, President Trump signed the big, beautiful bill, as it's dubbed, which has a number of features, far too much for us to go through on a podcast such as this, but we'll just mention a few of them. The most important thing is it made the 2017 tax cuts that Trump 1.0 enacted permanent. It also introduced some new temporary tax breaks, such as no tax on tips, no tax on overtime, and also for some seniors, Social Security income will not be taxed. Also, the SALT tax exclusion, the state and local tax, which had been cut down to $10,000, was actually increased to a $40,000 limit. There were some other elements to the bill. There are spending cuts to Medicaid that's gotten a lot of attention. Probably the most controversial point of it is that they will include work requirements for able-bodied recipients of up to 20 hours a week of some type of work. Also, there's increased spending for both border security and for national defense. And lastly, and this is a big one, not too happy about it, but it did increase the U.S. debt ceiling by $5 trillion. So markets, generally speaking, I'm sure we'll see over this next couple of weeks, but it's favorable. We now have it behind us, and we can focus on other things, such as GDP growth. So second quarter GDP growth, and the second quarter ended last Friday. Second quarter GDP growth, Atlanta Federal Reserve estimates growth last one I think I'll have for an update, of 2.6%, slightly higher than it was the week before. So again, first quarter really weak, largely because of tariff-induced pre-spending, imports coming in, dragging down GDP growth. But again, if we come in at 2.6% in the second quarter, plus that -2 means we're somewhere between 1.3, 1.5% growth GDP on a real basis for the first 6 months of 2025. Inflation expectations, that has hardly moved. Still at 2.33% for the next 10 years, expectation-wise. Fed funds. There is a meeting this month, and the expectation is the Federal Reserve will not cut rates, particularly with the stronger jobs data that we saw last week. So the odds of no cut has increased. It was 79% the week before. That rose to 95%. In terms of the rest of the year, expectations have come down again. In terms of Fed rate cuts, the odds built into the futures market of getting 2 cuts or more had been 93% prior week, came in at 78% last week, and then the probability of 3 or more cuts, that fell a week before, 62%, that fell to 34%. Now let's take a look at some of the return data from last week, given what was relatively favorable economic news, and near the end of the week, the expectation of a budget bill being signed. We had good economic, or I should say good stock performance here in the United States. S&P 500 for the week, up 1.75%. So it closes out the first half at a positive 7.5%. That's, I'd say, quite good after we had an amazing 2023 and 2024, and the fact that we had such a downturn in early April. So finishing the first half at 7.5% seems like a real victory, I think, for U.S. equity markets. Last week, again, up 1.75%, led by value. Value was up 2.4%, growth up only 1.2%, and small cap up 2.8%, where large cap was up 1.6%. In terms of international markets last week, slightly better than flat. Developed ex-US up 21 basis points. Emerging markets up 26 basis points. In both of those metrics, both of those indexes up significantly higher than the S&P 500 for the first half of the year. The developed ex-US up 17.1% first 6 months, and emerging markets up 14.5%. Lastly, in terms of returns last week, fixed income. Bloomberg Aggregate Bond Index hardly moved, down 9 basis points. We actually had the 2-year yield rise 14 basis points, and the 10-year up 7 basis points. So the fact that the Bloomberg Aggregate Bond Index barely moves is actually a good thing. Now, in terms of economic activity this week, data that will be released, there's nothing. This is one of the lightest weeks we will see in any given year. We will have initial jobless claims and continuing claims this week. Really, again, not much to speak of here. In terms of the initial jobless claims, the consensus is now 235,000. And again, as we mentioned last week, came in at 233,000. Last thing to mention, this really just came up this morning. The BRICS countries, which is a coalition of countries that are trying to put together a currency to rival the U.S. currency as a world reserve, had a meeting, I believe it was yesterday, but the Trump administration today. The Trump administration has a 90-day hold on many of the tariff agreements or the tariff stances that we had back in April when we just halted it for 90 days. So that comes due on Wednesday, and the expectation is what the Trump administration will do is simply tell each country that hasn't negotiated a pact yet or is not negotiating at this point, we'll just tell them what the number is and tell them to pay it. We'll see how that goes. But the more important thing is the BRIC meeting, which a lot of clients have actually brought up to me and asked about it because it does potentially threaten U.S. dominance in terms of world currency. The BRICS country, the meeting Many of the big hitters didn't show up. So for BRIC, it's Brazil, Russia, India, China, South Africa. There are a few others that are in there. Others such as Egypt, Ethiopia, Iran, UAE, and Indonesia. So they're trying to put together a currency and make that take a chunk, have it take a chunk out of the US dollar. Well, the Trump administration obviously doesn't want that. So today, the Trump administration said they would slap another 10% tariff on any country that is supporting the BRICS effort of creating this new currency. Not sure how that's going to happen. The whole tariff thing has been very fluid, but nonetheless, that has come up. But the last thing on the BRICS discussion in terms of a reserve currency or a currency that would threaten the US dollar, Russia, Putin didn't show up. Xi Jinping did not show up from China. So I think the expectations dropped dramatically in terms of the probability of success of that meeting. And just in total, while it would seem to be a relatively easy thing to do, it's actually very hard and will be very difficult to get the rest of the world to go use a currency other than the US dollar that they've used for the last 50 years. So that's our take on it. That's a whole wrap for our weekly economic update. We thank you for attending, and we hope you join us next week. Thank you.